having a large income. Well, being self-employed, you have benefits that people that are working for the man or the woman do not. And what we're talking about is some retirement plans. There's a lot of different retirement plans that you can contribute to if you're self-employed. So I'm a sole proprietor, I have my own business, and I'm making some profits. There's different things and different levels of plans that you can choose. Al, the SEP IRA, I would say, is probably one of the most common self-employed pension plan or retirement plan, but I don't know if that's the best. But why do you think the SEP is more common than most?
Well, I agree with you, Joe, and the reason it is because it's probably the most simple. And you can do it after the fact, and what I mean by that is all these other plans you've got to set up within your same calendar year of your business. A SEP IRA you can set up in the following year before you file your tax return, and that's often when people think about this. They have a certain amount of profit, and I can set up a retirement plan and take a tax deduction. So I would say that's why that's most common.
So these other plans you need to set up prior to the end of the calendar year. Simple IRA, well, it's simple to set up as well, right? But they have different contribution limits. Everyone's pretty much familiar with the 401k, but if I'm self-employed, I can set up what is called a solo 401k or an individual 401k. So I have the same benefits as the big 401k plan providers, but there's added benefits because now I'm a solo practitioner. I can potentially put a lot more money in. And then here's the big daddy of them all. It's the defined benefit plan. This is where if you're making significant amount of money, you can shelter hundreds of thousands of dollars pre-tax into these types of plans, all for your retirement. So it really depends on the level of income, the level of complexity that you're looking to do. And I don't know, Al, why they have so many plans. I mean, let's just make this a little bit more simple. They call it a simple IRA, but it's far from simple.
It's not really that simple, Joe, and you are right. And speaking of a defined benefit plan, for example, this is the plan that you set up when you make a lot of money. You're generally older. It's based upon a future benefit, not a contribution limit. So in many cases, people are able to get a couple $100,000 into it. That's a great tax deduction, but it's expensive. It's expensive to set up, it's expensive to administer each year, and it's expensive to terminate.
So when you look at just comparing these plans, is that you have a SEP IRA, simple IRA, 401k, defined benefit plan, but there's also money purchase plans, there's profit sharing plans, and even a couple of more. But this is for someone that is 50 years of age or older, and here's the max contribution limits. So on a SEP IRA, which Al talked about, you file your tax return next year, and you say, wow, look at these profits. I want to shelter some of this from tax. You can set up a SEP and contribute 20 to 25% of that compensation. So it's a good shelter. A simple IRA, you have to establish before the end of the year. There's some deadlines here in October, actually, but you got $15,500. That's the maximum allowable that you can contribute. Then you got $24,500. Right? So that's the 401k plan. So everyone's kind of familiar with those limitations, $18,500 plus the catch-up of $6,000. A defined benefit plan is calculated based on your age. So what they're doing is they're trying to front load this thing to give you a certain amount of income when you do decide to retire. But then here's what's unique about being self-employed. Now I'm self-employed. I'm the employee and the employer, right? So I can double dip a little bit. So actually your defined contribution plans are about $55,000 that you could shelter. If I'm looking at a simple plan, I want something a little bit easier, maybe up to $23,000, $24,000. The 401k plan, if I include a profit sharing plan on top of that, could be up to $61,000. And then a defined benefit plan could be up to several $100,000. So when you're looking at this, it's like, man, I'm self-employed. I can shelter a heck of a lot more money from taxes than if I'm just a regular employee, because then I'm just stuck to certain levels here. But I think where the real meat comes to play here, Al, is the new Tax and Jobs Act that just came into effect at the end of last year. For self-employed people, you really want to make sure that you understand how this QBI deduction works.
Yeah, it's called qualified business income. And this is what happened. So in December of last year, the new Tax Act created a new tax deduction for small businesses. Small business being defined as a flow-through, a business where the profits flow through to your individual return. You can deduct up to 20% of your profits. So if you gross $150,000 in terms of income, you have $50,000 of expenses, you end up with $100,000 of profit. 20% of that's $20,000. That's the amount of potential deduction, this QBI deduction. So what that means is you'd only pay taxes on about $80,000. So to look at a quick example, Joe, if you've got that $100,000 business, you may be only paying tax on $80,000.
Yeah, you take a look. You have $100,000 of net profits from your business. Well, here, this 20% deduction, that's the QBI, qualified business income deduction. Well, I get 20% out the top here. So I'm going to be taxed on 80% or $80,000. Well, guess what? Put another kicker on top of this. We just went through some retirement plans. Now you add a solo 401k to this, and then you can continue to shelter more and more dollars. So this is going to be huge. Let's say for all of you real estate owners out there that have rental real estate, there's another huge thing. You got rental property that's bringing in $50,000. Guess what? You get this QBI deduction on rental property. So right here, 20% of 50 grand, I'm only taxed now on 40. So if I'm looking at small business owner, real estate owners, this QBI or the 199 cap A tax deduction is absolutely a monster, but it's so dang complicated, Al.
Well, it is complicated, Joe, and really to try to simplify it the best we can, there's a couple things you need to be aware of. And so the 20% QBI deduction, it has to be it's going to be the lesser, there's another limitation, lesser of that or 20% of your taxable income, whichever is lower. So you got that limitation, and then probably even more importantly, if you're single and your taxable income's more than about $157,000, married $315,000, it gets much more complicated. And then there's all kinds of other limitations, whether you're service business or non-service business, how much you pay in salaries, what's your cost basis of the equipment that you depreciate. Joe, at that point, it's anything but simple.
Right. So I think the point of this is that if you're a small business owner, you're making less than $157,000 as a single person or $315,000 as a married couple, there's a lot of things that you could potentially do. But all of a sudden you get into these phase outs, we've seen all of a sudden tax spike up to about 40-50%. So you want to make sure that you understand this.